So actually, I was working on the PowerPoint this morning for about an hour, and um, about 25 minutes ago, I lost the entire thing. So um, I tried to do a slimmed down version of it, and as I was going through it, I was noticing stuff I wanted to talk about each company. Can everyone hear me? Just to make a test, just make sure if someone could just write in the chat that they can hear me.
Yes.
Okay. And then also, the other thing is if you do have your mic turned on right now, if you wouldn't mind just either like turning that down or turning it off, um, just so we don't get a lot of feedback or extra sounds, that'd be great. So today, so as I was going through, I was noticing things I want to talk about at each company, and um, noticed that I had a lot basically to say or to look at for each company, and so we're actually going to break it down and probably do it into two sessions. And today we're going to look at IBM, Apple, Starbucks, and Panera. So two tech companies and then two sort of food kind of companies. And as most of you might know, Panera is like my number one holding in my own retirement account. So it's my favorite stock for long term. So we'll look at that one. We'll also look at why I think IBM and Apple are going to do really well in 2013, and why Starbucks should continue to do really well in 2013. So first off, we have these nine companies that we came up with for 2013. Again, if you have your mic on right now, if you would mind turning that off, that'd be really great. Because we're getting a lot of feedback from someone, so I'm not sure who it is. So how do we come up with these nine investments? Well, first of all, I do like a ton of research, and what I do is, we're looking at just reading about what's going on at the companies, figuring out what's the current survey of the company, and we have these basically like 150 companies that we cover in equity analytics, and each one of these companies, I try and pay attention to, learn about them, see what's going on with them, just sort of know what's going to be happening in the future for each one of these, and then we do a price target analysis. So we do discounted cash flow analysis, and I'm going to show you actually for the four companies. We'll look at the DCF analysis for each of those companies, so that you can see what I'm seeing, with each company. We do a comparison to the current prices for each company, so looking at what we've come up with, how that compares to what's currently being priced for the company. And then finally, I think the last thing that, sort of what the actual picking of the nine is sort of like my own intuition, you take, because we have about, I think, maybe 20 companies that were buy rated at the end of the year, and so how, out of those 20, the nine that I actually ended up selecting as I think the ones that are going to be the top ones, sort of comes, combining that sort of research and understanding of the company with the actual price targets. So the first company, the way I wanted to do the meeting was basically I'll spend about hopefully around 10 minutes on each company looking at it, and then we'll probably hopefully have about 10 or 15 minutes at the end where we can do our questions like we normally do. And we can, during that question time, we can kind of do any kind of questions. If you guys want to do a little technical analysis, you have some charts you're wondering about, we can do that. Or if you have some questions about any other companies or anything like that, feel free to ask. So, all right. So first off, we have IBM. Currently, the price target I have for IBM is $285, and that's drastically higher than the current price for IBM. Let's go ahead and take a look at this long-term chart on IBM. This is the chart since 2005, and you can see that it's gone through a really strong growth phase from 2009 to 2012. The key was right here in late 2010. This really started a really nice uptrend, and right here was when they released what they call their Power 7 servers. And their Power 7 servers was a really, a large development for the company. These brand new servers, it came with a lot of software, a lot of enterprise software, and a lot of companies, were buying these servers, and it was basically a cash cow for the company. And so that was the reason for that. And actually, this year in 2013, they're going to be releasing the upgraded version of the Power 7 server. It's going to be called the Power 7 Plus, and that's actually one of the reasons I really, really like the company. They've sort of flattened out in all of 2012 as this sort of growth phase sort of ended a cycle, and I think that that growth phase is basically going to restart at the end, sort of in the mid to end of 2013. Let's take a look at the discounted cash flow analysis so you guys can see how powerful, like how powerful I think IBM could potentially be in 2013. So, again, if you have your mic on or you have like a phone or something like that, if you wouldn't mind turning that down or off again, because we're getting like a lot of other noises from other people that just help so that everyone can hear me. Operating income in, so here's, yeah, exactly. So 2000, so here's like projections. This is my DCF for IBM. I mean, you're looking at basically what I've done, and what you can basically see that I have very, very, very minimal growth projected for the company. This is what I call like a sort of fair value analysis. So what you're looking at here is basically we're taking operating income 2013, 14, 15, 16, and projecting out numbers. And really what I've done is I just basically put this as low as I possibly could, just really slight growth for each company. I've even taken a residual growth rate at 1%, which basically is the lowest that residual growth rate can be. Usually we look at about 3 to 6%. I've taken that down to 1%. Depreciation, fairly limited. Increase in capital expenditures each year. A very low increase of working capital per year. And we still come up with a $285 price target for the company. The reason being is that the company has such strong cash flow each year, and that cash flow continues to grow, and that cash flow is divided by actually a fairly small number of outstanding shares for such a size of a company, that you get this really strong implied price per share at $285. Now, like, this model shows about, what, 2% growth of earnings, not even 0.2% growth of earnings year over year, but going back to the PowerPoint slide, analysts are currently estimating over 10% growth of earnings in 2013 for IBM. Now, 10% growth in earnings isn't like, you're not a growth stock, maybe a high growth stock, but for a company that's as sizable as IBM to have 10% growth in 1 year in earnings year over year is going to be fairly significant for the company. And in fact, it's reflected in how the shares are so cheap, because the current future PE for the company is just over 11. So I see a lot of potential for this company. There's a lot of the share prices aren't really reflecting a very strong growth model that should happen for the company in 2013. Talking a little bit more about the company economic moat. This is another thing that is really important to me when I'm looking at these companies that we add to the extended value portfolio and things that we like for long-term success. And I think that IBM has such an amazing economic moat. I mean, you look at first of all, the amount of time that the company has been dominant is just a testament, first of all, to their economic moat. And, looking at companies that have sort of been dominant in the early 2000s, late 90s, sort of those tech dinosaurs like IBM or like Hewlett Packard and Dell. And we've seen sort of that Hewlett Packard and Dell haven't been able to compete in this sort of new technological developments that we've had over the last few years. And IBM has. They've continued to show growth. They've continued to show very nice margins. And so I think that they have a very strong economic moat. I think that that's going to continue to stand for them, and especially in 2013, like I'm talking about here, they're releasing their Power 7 Plus server series. And not only is it great that they're releasing that the Power 7 Plus, and that will allow them to see a lot of new clients and have a lot of clients upgrade their current servers, but there's so much that comes with each additional model upgrade for them. You have new software for companies, new application software, new cloud software that's going to come with these servers, all these add-ons that go into it. So, once you get a new client, not only are they buying a service, but they're buying new software, they're buying new, they're continuing to upgrade the servers over the next couple of years, and so you get these sort of 1.5 to 2 year growth cycles that sort of happened in 2010 to 2011. It's going to start again for 2013, 2014. So I look for IBM to be a really strong growth stock with very good value for the next couple of years, at least cyclical growth stock. Current technical. So is this a good time to enter the stock? And looking at, let's look at the three things I like to look at for longer term growth is the 50-day moving average, the 200-day moving average, as well as the 20-day moving average, and then looking at MACD, so stochastics, and we can look at RSI and we can also look at CCI. And so taking a look at the chart, I'm seeing some pretty nice, a fairly nice technical setup long term. It's not quite as good. What we want to see typically for long term, if we're looking at like a short term entry, what we want to see is MACD's moving to the upside, so stochastics moving to the upside, RSI, CCI moving to the upside. For longer term, it's not quite as important, but we definitely don't want to buy, right at a high. If we could get it in a, if we're looking at a stock over a 2 or 3 week period, we want to buy it at sort of a lower, at a low, and allow it to develop, because we're going to be holding the stock for 6 to 12 months. So the MACD here we can see is trending fairly nicely, and it's just breaking over 0, which does show you fairly good technical strength. Also, so stochastics are breaking to the upside. RSI has dipped as of late. I don't tend to use RSI too much. So if we take a look at CCI, I think it'll give us a better indication just because it's a wider range. So update that for that. And so right now, you see stochastics just breaking over 80. They're kind of showing a top. CCI is showing a little bit of a breakdown. MACD is trending higher over a long period of time, but also you're seeing that black line cross back over the red line right now. So I would wait on entering IBM. I think it's probably maybe going to sort of flatten out around here. It got a lot of resistance at the 200-day moving average. Right there, you can see it's kind of in the top here, here, and here. It hasn't been able to break through it. I think you want to probably wait to buy it if you aren't in it already, maybe on a break of the 200-day moving average. All right, so that's IBM. If anyone has any questions about IBM, I'll go ahead and put them in the chat right now, and then I will get to them. But I think what the moment everybody's been waiting for is what I think is going to happen to Apple in 2013. So I have a really strong price target on Apple, $850. Whether or not it's actually going to be able to achieve that, that's one thing. But that's 60% higher than the current price, basically. So, as long as we get close to that, or even come anywhere near that, that's going to be good for Apple investors. We look at the long-term chart of Apple, and this has been a really great stock. I mean, obviously over the last few years, and you see this very strong uptrend. It was really great, and I think actually 2012 was actually a disaster for the company, because what you got was basically it became a trading vehicle, and it became sort of this stock that was no longer just this great blue chip that you could invest in that just kept going up and up and up, and it sort of became everything was sort of being priced in all at once, and traders were coming in and moving the stock around, hedge funds were moving around for short-term gains, and I think 2012 will be looked at, and you can't really look at this year as it's kind of like I would rather just look at 2012 back here. And you do see such a great long-term uptrend, and I'm hoping that 2012 was an anomaly for the company, and then it kind of resumes that uptrend in 2013. We'll see, though. So looking more at the company, our DCF analysis right now is pricing growth of only 13% for earnings in 2013. Analysts are expecting growth to be about 17% for the company. So let's go ahead and take a look at our our DCF analysis for Apple here. And here you can see, so 2013, I'm expecting $63 billion in operating income. And you'll see in 2014, about $74 billion. So actually I'm expecting a larger increase in operating income here in 2014. I've priced in sort of a year where I think in 2015 where I think Apple's going to see some flat growth, and I think that has to happen at some point for the company. I just think that it's been on such a strong growth trend that I wanted to price in just a year where it goes flat, just because I want to price a model that is, I think, more realistic for the company. So really, over the next 5 years, I'm seeing about 30% growth in operating income. I don't think that that's a really large amount. I don't think that that's much more. I don't think that that is higher than most people are expecting. I think most people are actually expecting a lot more. And I'm still coming up with an $850 price target for you in the shares right now. Residual growth rate at 3%. That's 4% is what I like for a growth stock. So I'm pricing it in a bit below normal growth. Pretty good tax rate there. Depreciation keeping pretty flat. A lot of capital expenditures I'm pricing in again to keep to keep a less aggressive model. And again, I'm coming up with a very high price target for the company. So I do think that there's a lot of value in the shares, and that will be reflected in the fact that they have a future PE at 9.2, which is extremely low. You're looking at, if you can get a future PE below 15, typically that's a good place to buy a stock. And this is below 10. This is very, very cheap for Apple right now. Continuing with our discussion of it, I think the main discussion with Apple has been, I think everyone has a lot of opinions about the company, and feel free to jump in the chat here if you have any opinions you'd like to mention about it, because I think everyone has a lot of them. But the economic mode has been, I think, what's been questioned as of late for the company, and sort of, can Apple sustain the sort of amazing growth that they've had and the amazing saturation of everyone buying their products or hand over fist over other products. And I don't think that those questions are quite should be as strong as they are. I mean, I was looking at some research before this morning, and for the first time ever, Apple increased in total world market share of handsets and cell phones. I didn't know this, but for the first time ever in December, they moved over LG for the second spot in the world now, right behind Samsung, and they saw 1.5% market share growth from October to December. And that's looking at the total world. In the U.S., they're obviously much higher than LG and Samsung, but this is looking at the entire world. And I just don't think that we need to question their economic. They're really just starting to ramp up production in some of your emerging markets like China. Starting to really develop there as the same sort of image company that they have become here. And I think 2013 could be a really nice year for them. Actually, they have what they need to have is they need new technological innovations besides just upgrades to the iPad, the iPhone. We all love the iPad, we all love the iPhone, and the upgrades are sort of becoming, up to each one. That's like, that's cool, but I don't have to have that. What they need is they need the new products that people have to have. And I think that you're going to get some of those. So first of all, this one's not quite as cool as the rest, but they've got Apple Radio coming out in March. And Apple Radio is going to be basically like Apple's version of Pandora. They've seen the success of Pandora. They want to have it do it themselves. And one of the things that they haven't been able to do is take their iTunes idea and sort of make it a social sort of application, like the way maybe Spotify has or Pandora has. So that's what Apple Radio hopes to do. And then there's a lot of speculation, and if it does come out, I think it's going to be a really good year for them, is Apple TV. And they have the Apple TV product right now, and it's basically where you could take a small black box, you hook it up to your computer, your TV, and you basically get sort of like a version of iTunes on your TV. But what they haven't done is they haven't actually released their own TV, and that's what they're expected to do in 2013. Instead of having a Sony TV, you actually have an Apple version TV. They're going to develop their own TV. It's going to have all these. There's speculation on what all the features will be, but I have Apple spelled wrong. Sorry. And then finally, they're supposed to release these new MacBooks that will have this, basically what they're calling gigabit Wi-Fi speed. What exactly that means, I have trouble understanding because it's very technological. But basically, it's going to be, you're going to see laptops that are going to work at even a faster rate than they currently do. And what it's going to be really great for is enterprise, and that's where I think Apple has the most growth potential. They've really saturated the consumer market, and they're going to continue to see a lot there. But they haven't been able to saturate the enterprise market, meaning working with companies as well as, and I think that's where the most growth potential is. And those new MacBooks and that new computer line is going to be really great for them if they can get this gigabit Wi-Fi speed, because what it'll essentially mean is that companies will be able to use Apple products, and their computers will be able to process in the Wi-Fi market, Wi-Fi networks, excuse me, at such a faster speed than any other thing that's on the market right now. So that's another really appealing product that is going to be coming out in 2013 for them. So I do think there is a lot to like there, and I think that sort of some of these problems, and everyone's coming out of the woodwork right now about Apple saying, oh, this company's done, or oh, they don't innovate anymore. And we've sort of avoided the stock as of late just because it's been hard to trade, and it's been just, sort of, it hasn't been great as of late. But I do think that you can feel comfortable buying the stock right now because it is so cheap. And if you're willing to say, I want to hold this for 12 months, I think you're going to see a really strong reward. Let's take a look at the current chart there just to sort of see what we're looking at right now. Yeah, so Apple, after making this great increase, which killed my bear call spread that I had on the stock, you came up to the 50-day moving average here at 555. But again, on the first test you saw here back in late December, could not break it, and again could not break it on the second attempt. So still we haven't seen any technical strength in the stock develop yet. It's in a very strong downward channel right now, and it is definitely weak technically. But at the same time, if you look at it on the long-term, outlook, you're seeing really strong support here at 500, and you're also buying the stock at a very cheap level when you saw the 9 future PE. So if you can deal with some of these sort of current ups and downs and look at it on a 6 to 12 month outlook, I think that you can be rewarded very nicely. And earnings are coming out in mid-January, so that will be a big moment for the stock. All right, third company to look at today is Starbucks, and we had a really successful year with Starbucks. I think the stock increased about 16% for the year, and we've traded it with some options, a little bit in the short-term equity portfolio, and there was also a really nice holding for us in our extended value portfolio as well. So my 2013 price target for the company is 72. Taking a look at the current chart long-term, Starbucks has been in a great uptrend since 2009. Bottomed here with the recession, and has really just done very well as of late. And again, you see in 2012 sort of such a great volatility for the stock. Like many of the other charts we're seeing, we're not seeing that same kind of just strong uptrend, and that's going to happen. After you see such a strong level of growth, you're going to have these flattening periods. The question now again for Starbucks is, can they continue higher after this, or will they continue this, or will it continue down? Well, I think that we're going to see a movement up towards around here, above 70. There's several reasons why I like this stock. First of all, the PE ratio of the company, current PE, or the future PE ratio is about 21, which is definitely not cheap at all. And you have to be buying Starbucks as a growth stock, and so it has to be able to maintain growth. And the question is, can Starbucks maintain growth? Well, I'm currently pricing in my model about 25% growth in 2013, about 18% in 2014, which is a little bit higher than analyst estimates at 21 and 18%. But I don't when I'm looking at growth stocks, I price them for growth, and I don't price them like I would price IBM or maybe even Apple, where I'm not pricing IBM as a growth stock because I don't think it's a growth stock. I think it's a dividend stock and maybe a value stock if we can get it as a value play. So looking at the Starbucks, I gotta get the Starbucks Excel file up here. That's Panera. Here's Starbucks. So I'm looking at about $2.37 billion in operating income in 2013. Seeing that increase about 18%, and then sort of seeing that growth sort of trailing off in 2015, 16, and 17. I think the next few years are going to continue to be very strong growth years, but I don't think that they can maintain 20% growth past about 2014. And you're going to see, I think, it come down to around 10 to 12%, and that'd be sort of where they stay for these 3 years. Again, the residual growth rate is high at 5% again, this is a strong growth stock. We do see depreciation slightly increasing, I think that actually capital expenditures are going to come down for Starbucks. They had a really big year in 2012, and I think that will probably stay in 2013 with a lot of acquisitions of, they bought Tivana, and then earlier in 2012 or maybe it was late 2011, they bought Evolution Fresh. So they have been doing a lot of acquisitions, I think, and then they've also been developing some new products like their Verismo Brewer, which is their single-serving brewing competes with the Green Mountain Coffee Roasters. So I do think that those capital expenditures are going to come down. That's why you see that declining here. And again, I do have that $72 price target. So, these price targets I'm coming up, I was like, oh, well, how does David come up with these? Well, they're really not arbitrary at all, and I put a lot of time and a lot of thought into how they develop. Obviously the numbers here, these aren't exact, but you're looking at sort of the trend, and as long as we can understand what the trend is going to be, I think that really allows us to get a really nice price target for the company. So a little bit more about when I'm looking at Starbucks. So economic mode, I think, is another key thing to think about with Starbucks, and they have had like an amazing dominance over its competition, and it doesn't make any sense because it's coffee, and it's like everyone can make coffee. But they've been able to have such premium pricing power, which has allowed them to have unbelievable margins, and then also expanding those margins, and then also that they've been able to do it on such a large scale. It's a testament to the company. Their continued, you know, I've never been, they have a great product, and also the ability for the company to include others types of ideas other than coffee, including sort of music into the Starbucks image, and also, other types of food products. And then now they're moving into the single serving industry, and actually the first results from Verismo have not been actually that great. And I actually think that that's going to be a little bit of a drag on the stock in 2013, but I think that there are other things that are going to be overshadow that. And one of those is the company has really, really strong expansion plans in China and India, and I think that that's going to be an extremely strong growth area for them, and also in the rest of Asia. They just actually introduced their first store, I think this past week, in Vietnam, and so they have a lot of countries where they have very little coverage, and they're moving into those countries. I also do think, despite the fact that a lot of people don't, I think that the Kivana acquisition is going to be very good for them. I think that you're starting to see sort of tea become sort of this, I think, a kind of cool new product again. I think Kivana is sort of on the edge of becoming a bigger company, but and once you take Starbucks and you put that entire model in with them, it's going to allow Starbucks to increase their sort of tea coverage at their own stores, and then also allow them to use their unbelievable scale to take that company and make it much better than it is. But I actually think the best thing that they did was the Evolution Fresh. And Evolution Fresh is basically like a juice style company. It sort of was, if you ever had those naked juices or anything like that, it's sort of these really, really premium juice products. And they basically want to take that and they want to kind of model it in the same way that Jamba Juice has become so popular. And I think that that's a really successful business, and I think that they can do really well with it because, again, you're taking the Starbucks sort of way of doing things and applying it to a new idea. I think that that's going to be really successful for them as well. I don't know is it. I think that you're not going to see that really starting to show a lot of growth in the actual numbers in 2013, but I think that's going to be something that people are like, okay, this is something that's going to be very successful for the company. You're going to start to see that price in 2013, and it also allows them to maintain their growth stock image, which is what will help them to maintain such strong price PE ratios. When you're looking at growth stocks, you got to find those companies that have growth, but also have things that are coming on in the future that are going to allow them to maintain that. When you look at other growth stocks, for example, the first one that comes to mind is like Deckers Outdoors, who made Uggs. When they were making Uggs and those were so popular, the PE ratios, they went skyrocket on the company. But if you look at the future of that, does the company have anything coming up that's going to allow them to maintain that PE ratio? And they really didn't, and that's why you've seen such a strong decline in the company's price. Maybe it's come to an area where it's a buy or something like that. But anyways, that's sort of what I look at when I'm looking at these growth stocks. I don't, you got to be willing to, when you're committing your money to a Starbucks and you're saying they got a 21 future PE, a lot of growth has already been priced in that stock. is there something that's going to allow that to increase in the future even more? And so I think it does. All right, let's take a look at the current outlook of Starbucks, and then we can go into Panera. Any questions anyone has yet? Feel free to put them. Yeah. Okay. Well, so Starbucks, we're gonna.
I have a question.
Okay.
Hello.
Yep.
How long do you think for Starbucks? Do you think this is a good entry point for it?
That's
I missed it. I'm sorry.
so. Yeah, I'm actually gonna look at the chart right now, and we can look at the an entry point for it. And yeah, so Starbucks has been kind of on a tear as of late. I can't remember. I think we were talking about it the other day, but all right, sorry. So right now, it's tough to. I wouldn't enter right now. Okay, looking at the chart, you're seeing CCI at 191, almost 200, which is basically like the highest that CCI goes. You know, sometimes it'll go a little bit over 200, but it's basically at a high. You've got MACD. You got the black line that's crossing over the red line, and actually this is fairly low. It's just below 1. MACD can go much higher than this. And then you also see slow stochastics are showing a top. This only goes to 100, and it's at 94.65. So this is at the top. The technicals are all showing they're at the top of their range. So I do think that you're going to see Starbucks flattening out. What I would wait for is, okay, of course, down here was a great buy point. Right down here below 53, sure. And down here was a great buy point, sure, right here. So obviously, if we could find a time when the slow stochastics had moved back to around 20, that'd be a great buy point. And that might not happen. So I think that if you see Starbucks sort of flattening out, and you see the CCI come down to around 0 again, or even a little bit above that, coming back and testing this 20-day moving average would be a good entry point. I would definitely wait and see if we can get some flattening of the stock. Wait for the 20-day moving average maybe to catch up to the stock price. Again, I would not recommend an entry if you're looking at buying it for a 6 or 12-month hold or even longer. Then there's no reason to rush into the stock, right? So we can wait on entering. If again, you're just waiting for a dip or waiting for the stock to flatten out. So yeah, I don't think right now is the best time to enter. I do, so for the buy, so 72, yeah, I think it's good buy below 56, basically, 57, 56, so I do think that it's in an area where it's still a nice buy for long term, but we want to look, if we want to buy the stock and we want to hold it for a long period of time, I mean, why not look for a really great technical level or a nice technical setup for the stock, so that's kind of what I'm seeing with it. But yeah, below 57, I like it for an entry. So again, if you're not willing to be patient with it and you want to get into it right now, then selling puts on Starbucks. Yeah, I mean, you got the 200-day moving average here at 51.70. So below 51.70, I mean, you got the 20-day, the 200-day, and the 50-day all above 51. I think if you could sell the 51 puts on February or maybe on May, I feel like you got to be feeling pretty good about that. I'm sorry, May. I meant March. Excuse me. February or March. I'm not sure which ones are available right now. I think that you could like that. 50 is a pretty clean number, so maybe you're looking at 50. And then, what the great thing about selling puts on a company, if you really like them for the long term, is that if it does come down to there, and you can get the stock. You can get 100 shares of Starbucks at $50, and and then in the meantime, if it doesn't go to 50, then you're making money on the options. So I do like that strategy, Robert. I think that Starbucks is a really good company to do that for because you do have such a really strong chart in Starbucks, and it's not going to have, you see these drastic gaps, and these are all with earnings. So that's sort of something to be wary of with the company is they do move pretty heavily on earnings. So, maybe taking that into account would be something that you want to keep in mind when you're selling puts on the company. Any other questions about Starbucks? We're gonna move on to Panera. Yeah, we've done really well with the credit spreads on them. They've been very consistent. The thing they like, as long as if you look at it, you look at these periods of times in between earnings, and it's been pretty strong. You got this weakness right here, but this was a very rough time in the market. I mean, we go back to let's look at like a year long. Yeah, I mean, in between earnings, this stock has been fairly flat or in growth mode. Here drop down on earnings, growing, gapped up on earnings, flat with some growth. I mean, it's been very good for credit spreads. I think we've done tons of them on it. I think we maybe did 6 or 7 last year on them, and I think almost all of them worked. So, all right, let's go on to Panera. Last one for today. Okay, Panera Bread. Again, I said basically my favorite stock for the long term. My price target for 2013 is $200. You're trading about 160 right now. So you're looking at about 25% potential maybe for the company in 2013. I think that's very realistic expectations. The chart is long term is amazing. Let's take a look at it. I might be a little biased in talking about this, so just be aware of that. But you're looking at since 2005. I mean, the chart, and since 2009, the chart's just been on fire. And I really don't see that. And one of the things you see is you don't see a lot of volatility in that. You do see some months where you're going to have these, but for the most part, it's been just pretty much trucking along. Looking at the DCF analysis on the company, let's pull that up here. So basically, right now, I have 21% growth expected for 2013 in operating income, and I've dropped that to about 10% in 2014. And then moving forward from there, we're looking at, just about a little bit under 10. And so this is another growth stock, so you have 5% residual growth rate. And what I've done here is I've shown you basically with really low expectations for the company that are vastly below what analysts are expecting. This stock, on my model, is worth about $200 per share. So there is a lot of potential for this company, and $200 per share. If you don't mind, just if typing in any questions in the chat, it just helps make the flow of the webinar work a little bit better. I appreciate it. Thank you very much. So the $200 again is the implied price per share, and then depreciation pretty much flat. Again, in my model, I have a lot of capital expenditure growth from 135 million to 185 million, and that's due to store expansion. The company's really ramping up store expansion. And that's actually what we're going to talk about for the company, the reason why you can really like this stock. But they're probably going to be adding about 250 new stores every year for each year here, 2013, 2014, 15, and 16, and that might even increase. And then additionally, I think that around this time, 2014, 2015, they're going to start to move into some international expansion, which is a whole nother ballgame. I mean, when you're looking at Panera, it's amazing that it's such a the company, it seems, is such a large name, but yet it's really actually a very small company. They only have, right now, they only have about 1,600 stores in the USA, and while that might sound, I don't know if that sounds like a lot, it's really very small. So I was looking at this study. They looked at the highest saturation of stores that they have in any one area, and that's in St. Louis, where they were started. And they did basically, if you take the number of stores that are in St. Louis divided by that population, then take that and divide it by the total, that ratio, and take that divided by the total population. Panera has the potential for around 4,000 total stores in the USA. They only have about 1,600 right now. So you're looking at the company could potentially double, maybe even triple in stores just in the USA alone, and they haven't even touched international expansion yet. So the company, has a lot of potential, I think. And I'm talking, this is my retirement account, so I think that this company has potential. Yeah, exactly. They have amazing growth. They have no debt at all. I mean, you look back at the, they have exactly zero debt right here. You can see less interest-bearing debt. They have no debt at all. They have $256 million of cash, and they only make They only have $272 million in operating income in 2012. They have as much cash, as much money as they make. I mean, this is a cash cow right here, Panera's, and they're the only problem that I see for them, and I mean, we have to be honest about what we think about them, and we need to look at what could be the problems with them. Well, they don't really have much of an economic moat. I mean, it's very hard to have economic moats in food service. I mean, you can't, you have your recipe, sure, that's, your own thing, but there are so many other quick service restaurants, and in fact, there are more and more coming on as it becomes more and more popular. So I do think that competition is going to continue to rise, and I do think at some point that's going to be something that will hold them back somewhat. But I don't. I think that the expansion of the company as a whole is vastly outweighs that sort of competition rising argument. And the other thing is they're so consistent. The company has seen between 25% and 28% growth in EPS every year since 2007. I mean, it's been exactly 25% to 28%. It hasn't ever been below 25%, hasn't been ever been above 28%. So it's very consistent. It's consistent growth. The chart is very consistent since 2007. I mean, I love the company. I think it's a great company. Um, and that's, and the $200 price target is a very modest price target. I think that the company doesn't trade, or it's not like a trading vehicle, so I think that it can move pretty well to that price target. Um, yeah, so that's my opinion about Panera. Let's look at the current chart on it. I think that it actually has a fairly nice entry point right now. Oh, that's a All right. Well, let's pull this back down too. So right now, stock's building. CCI actually this is a pretty good trade right now. But this is actually this. You have the MACD right here. You see the black line just breaking out from the red line. Very very bullish image right there on the MACD. When those things happen, you get this sort of trend right here or here. The last time this kind of broke in that same area was here, and this is what you got. You got from 143 to 173. 1 second, Rob, but I'll get to that in a second. Also, the slow stochastics starting to creep up again. The last time they did that was the same sort of model was around here. So again, you're seeing a really strong growth right there. But we want to look at it as an investment. We don't want to look at it as a trade. So I think that if we're looking at the buy target I have for the company is 158 or below. So it is a little bit above where we want to buy the stock. We bought it, I think was it like last week, back here, or on Monday was like right down here, and it was about 157, 158. So I bought it here, and this was a great place to buy. It had the 200-day moving average support. We had the MACD low, the slow stochastics were down here, and the CCI was right at negative 100. I mean, it was a perfect setup for a long-term investment buy because you had everything low, but you had a company that you really liked. And it was a little bit of a risky buy because you do see these lower bottoms happening 1, 2, 3, 4 in a row. That's not a good sign at all for the company for trading. But as if I'm looking at the company as long term and I want to say I want to invest in this company, well, then we don't really care that much about that. We're looking just as this is a great place to enter because the stock is really cheap right now in comparison to where it was, and we think it's going to increase over the whole entire year. So with that said, I think that if you're wanting to get into the stock, I think you can buy now. The ideal place to enter would be below 158 on my model, which is where we got in. We just got in just below 158. But yeah, I think that you're going to see a very nice trend. It does have earnings coming up fairly soon. I'm not exactly, can't remember off the top of my head exactly when they are. They might be like early February. So that's something to keep in mind. Maybe you'll want to wait until after that happens. But then you run the risk of that they have a really great report and then it's vastly over this area right now. So if you like the company, I think it's a good time to enter. I think that you can feel good about entering right now. Maybe wait for like a test to back here, like 162 if you're really wanting to be finicky about it. But I think it's a good entry right now. Credit spread around 158. Yeah, I mean, I really think the level you want to look at, Robert, is probably 155 actually, because it's been 157 to 155 area. You see it's been supported here, the 200-day moving average, but it has broken through it. But 155 has been pretty solid. I mean, even coming back to here in August, you got it fairly good here. The only thing is I don't know. Again, you've got earnings, and that's always just such a volatile time. Going for March, I don't know exactly when their earnings report is, so it's something to keep in mind. I can look at it more on like Monday or Tuesday. Um, with I don't know when the earnings are off the top of my head. I guess I can look it up right now. Maybe let's see if it's actually right here. Earnings are on February 4th. Yeah. Okay, so I thought it was in early February. So early February is when the earnings are going to be. So yeah, again, if you're going to do any credit spreads for February, you're going to be dealing with a lot of volatility right before expiration. So you might want to go out to like maybe March or even further out, like May. I don't know if they have options available for March right now. And I think the level you might want to look at 155, but if you're going to go that far out, you maybe want to go down to like 150 and or something like that. Looking at the long-term chart, actually, looking at the weeklies, stocks have really good support at 150 in that area, and then 140 is even better over the past year. So if you're looking for something like you want to go long the stock and you want to do like a hedge, you might do like a credit spread around 140, 135. That would be a really nice credit spread for maybe like a May expiration. Give yourself a lot of support down here at 140, and then make some extra cash on the side. And then if it does happen to drop back down to that rate, then you can buy the stock at 140. Any other questions? Well, we got about 10 minutes left here. So if you guys have any questions about any of the stocks we covered today, any other stocks that you're curious about, like just maybe what my opinion is of them for 2013, and then if you want, or any technical analysis, if you can just like highlight, Robert, do you want to know what do you want to know about it? Do you want to know technical, or do you want like my current opinion about the company, or what exactly are you looking for? Okay, Priceline, option plays for 3 months. Priceline, I don't know. I don't have a strong opinion about Priceline. I like Expedia actually a little bit better than Priceline, because I like, well, the Priceline is just so volatile. So it's really, I don't play it for really long-term periods of time. What I like to do is I like it for I like it best for like weekly options, because the stock has so much volatility that you get a lot of volatility in weekly options on it. You get like a lot of premium in the weekly options on Priceline. And then if you can find some really nice opportunities, and it's really good for weekly option play. But I mean, looking at the chart over a long period of time, I mean, Priceline, let's take a look at it. I mean, if your intention is to own the stock, then the 550 level is obviously a great level to do some spreads at. With that said, you can hold that there, feel pretty comfortable about it for a long period of time, and then if you like the stock a lot, and you think it's a good growth stock, or a good stock to hold for a long period of time, then you can buy. Then if it gets down below 550, then you can own the stock at 550. That's kind of the way I would look at long-term option, with puts, is that you can use it to say like, okay, well, I really, really like, Priceline, or I really, really like Coca-Cola, or I really like whatever company it is. And you can look at it like a really strong support level over a long period of time, which is, for this company, it's been 550. It's been really great for the last year. And you can say, well, what I can do is I can just use that option there. I can put a lot of money into that option, or you can put a little bit of money into that option, and then you can use that in case it does go to 550. Then you can own the stock there, or you can make the money selling the put, or doing a full put spread as well. So I would look at 550. I think that's a good level for you to look at for Priceline. Any other anything else anybody wants? Got me here. I can do a chart analysis on any company you want. Anything, you guys. Someone put something up. Robert's really taking advantage of it. All right. McDonald's. I actually we just and I think that the stock is going to go to about 110 this year. I think that was my target. 108, I think is actually the exact price target for 2013. McDonald's is a stock that if you're going to buy McDonald's and you want to hold it for 15 years, you should buy it right now. I mean, the stock has been sort of they've kind of gotten hit over the last maybe like 3 months, but the long-term trend of McDonald's says that that's not what's going to happen to them. So if you want to sell puts in it, I mean, you might be aggressive. If you're going to go short term, maybe 85. I think that's a really good level. It's been very strong for them. If you want to go like a little bit less aggressive, the 80 level, then it's probably the second level. It's not going to go to 80 anytime soon. I mean, that's just not going to happen. You're not going to get a lot of premium probably in that either, though. So 85 would probably be the level I would look at. All right, CMG. I'm not sure what exactly. Do you want my technical analysis on the company right now? Okay, well, let's look at the chart on CMG. This is another one of the. This wasn't one of our top 9 picks, but it was like one of the so like an honorable mention because I do think that the company's going to make a big comeback. And we've been talking about it a little bit more as of late. And the stock really does look very good right now. As far as like buying it right now, I guess if you can, John, if you can give me your like, do you want to know trading it? Do you want to know do I like it long term? What exactly would you like to know about it? All right. Well, so I guess I have like a really high price target on the stock, and it's actually I think really undervalued. Um, they have really good support at 270. As far as buying it right now, I don't know if yeah, like technically the stock is fairly higher. It's been the CCI has been over 100 since early December, so it wouldn't be on anything I would want to trade right now because I don't think it's increasing. Maybe you would have liked it back here as like maybe a swing trade. When you saw all this stuff. The slow stochastics were showing nice strength. MACD was showing strength. CCI was breaking. But right now you've got slow stochastics above 80, pointing down. MACD is all the way up at 7. The black line's up at 7. I mean, that's really, really high. And CCI is above 100. I don't think that it's, if you wanted to trade it, you missed it. I guess if you want to hold it as an investment, sure, I think it's not a bad entry right now. But as far as like a trade for a short-term period of time, I think you might have missed it. But if you did want to sell some, if you wanted to do like let's get the real trade here. CMG, okay. If you wanted to do a spread, I don't know. Their earnings are on February 5th. That's what I was about to say. It's like so you can't really do anything for February, so you have to do something for January. There's not a lot of time left, so I'm not sure. I guess the level I would look at if you want to do something for January 19th, I think the level you look at is maybe 270. I don't know what the premium is on the 270 options. I don't think it would be very high probably. So you'd have to go more aggressive with maybe 285. I don't think it's a great idea. I just right, we haven't done anything with CMG even though I really like the company because the chart really doesn't show me a lot right now. It's a hard chart to read actually because the stock doesn't the stock it trades on such low volume because there's so few shares. I'll say that it's a little bit of a hard chart to read sometimes. But I do think, yeah, I don't know. I wouldn't really do anything with it personally. I wouldn't, I don't like it that much. The chart doesn't really appeal to me. They have earnings on February 5th, so you can't really do anything for February. With some companies you can because their earnings don't create much volatility. But for CMG, they create drastic volatility, like here, 400 to 340, or here. I mean, the stock moves on earnings, so and the best thing you probably can do on it would be like a reverse iron condor for February expiration. I mean, that's probably actually the best option, but you wouldn't want to do that until closer to the earnings. All right. Well, if you have any other questions, we can probably maybe do one more. If anyone else has a chart they want me to look at, or an opinion or anything. And then we gotta probably wrap it up for today. How do you feel about Whole Food Markets as a company in the long term? Yeah, it's like I don't have coverage on the company, Justin, so I don't have a price target for you. Um, I know that yeah, I was gonna say, I'm pretty sure their 4P is pretty ridiculous. It's at 27. That's really high. I guess, it's kind of like what I was talking about before, Justin. It's like, do you have something that, if you want to buy a growth stock, you have to say, like, is there something about this company that I think can help it maintain that same growth that it has right now? And for Whole Food Markets, I'm not really sure of that. I think that they do have a good company, and I think that in the long term, it's probably a fine stock. But to say, like, is it something where I think, okay, it could go to, I can make 20% on this company in 2013. I'm not sure about that, and I don't think you can. But given that, again, I'd have to preface by saying, yeah, I don't have coverage on the company. I have never done a pricing model on it. If you want to email me afterwards and say, just say, hey, do you mind doing a pricing model on the Whole Foods Markets app? I'm perfectly fine at doing that, and I can do a quick one, one that's fairly easy in about 5 to 10 minutes. So I can do that for you. I can't do that right this second, but just feel free to shoot me an email if you'd like to see that, and I can do that for you. But yeah, my initial gut reaction is probably like, I don't really think it's that 4P at 26.7. You gotta have a lot of growth potential. Go out on a limb and pick one stock for 2015. Well, I mean, I just picked four, Howard. I mean, I just gave you four. I mean, you want? I mean, okay. Here's one thing. All right, there is something. The new version of HTML is supposed to come out in 2013, HTML 5.0. And it might be the biggest technology thing of 2013. It's not talked about a whole lot right now because I don't think that they're not sure, like, how successful it'll be, or what will happen with it. But and I've done some research, and I try to find companies that would really benefit from that development of HTML 5.0, and I haven't been able to find any. But so if you can find a company that really has that would benefit a lot from that, Howard, I think that could be a high flyer for 2013. But I've had trouble finding any company that is like solely going to benefit from that sort of development. But again, no, those four I think are going to do really well. I guess the one stock that I think that maybe has the best potential out of all the nine I picked was probably, I don't want to say it, but I do think that probably Monster Beverage. I think this stock could really take off in 2013. I think that were held in check in 2012 by what happened with the FDA situation, and I think that they were on a really strong path until when that situation did happen. I think they've recovered from that. I don't foresee it being a long-term issue for them personally. Some people do, and that's what's holding the stock in check right now. And the longer that it doesn't become an issue or doesn't maintain as an issue, the better that the stock's going to be. They have an amazing amount of potential internationally. So that is another stock. I think as far as a stock that can just blow up in 2013, sure. Probably my best pick of 2013, the one I like the most, is Panera, but that's pretty obvious. So, all right, well, that's gonna wrap it up for today, guys. I hope this was helpful for you. The next time we'll look at Monster, Walmart here, VF Core, Arctic Cat, and MI Homes. Those are the other five. So I hope you enjoyed it, and I hope everyone has a good rest of the weekend. I'll see you guys on Monday.